And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's the first full trading week of October as we kind of kick things off this morning. Big news out this morning. AMD, the semiconductor chip company, has signed a deal with OpenAI to provide them chips for their servers, also allowing AMD to take about a 10% stake in OpenAI. That news this morning is going to push AMD up about 24% at the open. So, you know, AMD's kind of been trading flattish here lately. It's kind of been lagging some of the other chip makers in the markets like NVIDIA. Had a big correction back in April during Liberation Day, but it had actually been dragging even before that, had been underperforming. Well, that news today is going to certainly propel that stock back into the performance chart. So, again, that should help boost a lot of the chip sector itself today. Going to help support the market this morning a little bit here. We'll see what happens. But again, big news there for AMD. Again, that's going to give it about a 24% pop. So if you're long AMD this morning, you're going to have a really good day. Outside of that, Fifth Third Corp is acquiring Comerica Bank this morning also. So that's about an $11 billion deal in the finance sector. All this occurring even as the government remains shut down. So, despite all of the, kind of the trauma of not having an employment report on Friday, oh my gosh, what are we going to do without the, the BLS employment report? The markets are doing just fine. They're going to open up this morning. NASDAQ implied open right now is about up 175 points coming out of the gate this morning. And again, this kind of overall momentum in the market continues to kind of push things forward here. And that's not stopping here anytime soon. Call option volume has absolutely exploded over the course of the last several weeks, but actually the last couple of months. Really ever since Liberation Day, we've seen a gradual rise in single stock option trading, and that's just absolutely exploded here over the last couple of weeks in particular. That's at some of the highest levels we've seen. On top of that, volatility is also rising. This is something a little bit unprecedented. Normally when you have, kind of the momentum behind the market, you have dropping volatility, but volatility has been actually just kind of ticking up here as of late. And we'll talk some more about that this morning. But again, as we kind of continue just looking at, kind of the market itself, complacency remains very high here. Despite the fact we have kind of this little pickup in volatility, investors really aren't concerned much about anything. If you take a look at the differential between call and put options, nobody wants put options right now. It's just simply a moment of hate for the market. So I don't want it. There's market's never going to crash ever again. I don't want puts. But that's generally just the sentiment behind the market this morning. Again, lots of activity going on despite this government shutdown. That's going to get resolved. We'll have it resolved. I wouldn't be surprised to see a resolution, hopefully by the end of this week, get that behind us. We'll get a deluge of economic data reports all at once. The hope is that the government shutdown will be finished before the 27th of this month, which is the next Fed meeting. So again, that's kind of the risk, because at the next Fed meeting, we'll get another rate cut. And of course, the Fed already kind of knows what the date is. Even though we're not getting government releases, they have enough people working behind the scenes. They have a good idea of what's going on with the data. But anyway, there's an expectation right now, about 97.8% expectation the Fed will cut rates at the meeting this month. So, that's also kind of helping support the markets here a bit. So that's kind of just what's happening kind of cross headlines this morning. Again, nothing dramatic, but let's talk about what you need to know before the bell this morning. As I said, the markets are doing just fine. And on Friday, we just basically flirted with all-time highs a bit. It just kind of closed flattish on Friday. Really kind of no big deal. Again, the biggest risk is just, as we've talked about before, this kind of big gap here between the markets and the underlying moving averages. But again, we're seeing a lot of speculative push in the markets, really in a lot of asset classes, not just stocks, but as we've talked about before, you're seeing a speculative push in gold prices as well. Gold's continuing to do it very well. They're going to be up about a percentage point this morning because of the government shutdown. It's just kind of a trade on. But again, again, we haven't seen a stretch like this in quite some time where the volatility of the VIX has picked up here a bit, and at the same time, you've got an extremely overbought condition in gold prices on multiple levels. In fact, we haven't seen gold this really kind of overbought since this last kind of correction process that you saw previously. So again, just very, very extended here, but again, that doesn't mean anything until it means something. But again, you're also just getting very much like the markets. Again, the speculative push is giving you a very big deviation between moving averages as well. So that gravity is going to is just one kind of thing to pay attention to. But again, this is across all asset classes right now. We're seeing exactly the same setup in emerging markets also. And again, as we kind of just go across different asset classes in general, you just kind of see this kind of very similar setup of asset prices being driven. Again, this is emerging markets. Again, great run here, very extended from long-term means, very overbought. You see it in international stocks as well, developed international, very big gap between moving averages, very overbought. Again, it's just right now across all asset classes, you're seeing exactly the same type of speculative push. Again, nothing wrong with that. That's part of a bull market. That helps support prices right now, but you're also sucking a lot of capital into the markets, which you know, the thing that we've talked about before, and one of the things that continues to be the thing you want to pay attention to is that at some point, here's where the sellers are living right now. The sellers live up at these higher levels because, again, in order to get me to sell my stock, say you wanted me to sell you my Nvidia stock or whatever it was, you're going to have to pay me more for it because you've got to give me a reason to sell because the markets are doing so well right now. So sellers live up here. So sellers are demanding higher prices in order to sell stocks to people that want to buy it. The problem is that the buyers are going to live down here. So at some point when the market breaks, for whatever reason it does, there's a potential here for a fairly sharp decline because buyers live lower than where sellers are right now. Buyers are there. They're just not willing to buy here in most cases. So again, as sellers are dragging up the kind of the retail buyer into the market, the professional institutions are setting at a lower level saying, yeah, I'll buy it when it comes down to these levels. So again, that's the risk, and that's what sets the market up for these fairly sharp corrections like we saw in April. Doesn't mean we're going to have one tomorrow, next week, even next month. But again, at some point, something will happen and you get a fairly sharp contraction. So that's why we always talk about taking profits, managing risk, exposure, those type of things, because losses are important. You know, in the general scheme of things. In fact, that's something we'll talk about a little bit more this morning, is talking about bear market losses if they occur. But markets are doing fine. Again, nothing to worry about right now. Momentum's very strong. Just pay attention to the risk profile in your portfolio and you'll be fine. That's what you need to know before the bell this morning. We'll pick up, come back in a sec, talk a little bit about bear market losses. Also talk about the recession that didn't happen. Talk about that as well. Don't go away.
Got questions for Lance later? Ask now at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Here on Friday. Whoever was standing here was very short. John Penn was here. Why is the mic so low if John Penn was here? I don't know. Anyway. A couple of things. So on Friday, I published an article on the website talking about the promised recession. And this is kind of, you know, one of the kind of the anomalies behind the markets right now so far, which has been the fact that despite, you know, concerns over employment, concerns over these other things, that, there was this promise of a recession. This is going to happen. We're going to have a recession, and yet that hasn't occurred yet. Doesn't mean it won't, right? This is always the case. But last week, I penned the article talking about recession indicators, and I wanted to follow that up. And I've got actually there's a third part to this article that's coming out. We'll cover next Monday, is why there might not be a recession. Is the final part of this. But part of the conversation, and again, as we talked about before, if we take a look at, say, for instance, the inverted yield curve as an example, that has uninverted. Typically, when you have an uninversion of the yield curve, you can show this chart, Brent. When you have an uninversion of the yield curve, that's when the recession starts. It's not the inversion. We've talked about this before. It's not the inversion of the yield curve that's important. It's when it uninverts that typically marks the onset of recession. That's because as the economy slows down, assets are shifting, rates are getting cut, which drops the short end of the curve, makes the long end of the curve uninverted, and that's why you have the uninversion. That normally coincides with the beginning of the recession. And again, we've certainly got that. So it's like, okay, well, there's a recession coming. And then, of course, if we take a look at the ISM Manufacturing Index as an example, that's in contractionary territory. So again, historically, when ISM Manufacturing is in contraction, that is part of, kind of that recession indicator matrix that, is important to pay attention to. Because obviously, if we're slowing down in terms of the manufacturing of the economy, you're getting a bigger drag. So it just kind of makes sense. And then, of course, there's the Fed rate cuts. Historically, when the Fed's cutting rates, you normally are having either some type of financial event, that's why they're cutting rates, or you're heading into a recession, which is why they're cutting rates. So again, all these kind of things are piling up and saying, oh, well, there's certainly economic risk here, and something that we certainly want to pay attention to. But yet we haven't had this recession. So all the indicators are there, and yet this hasn't, really occurred. And so I wanted to take a look a little bit at, the things that are kind of supporting the economy right now and saying, look, this is one of the reasons that even despite these indicators, the market continues to kind of survive itself a bit. And I want to just show you this chart of growth. This is a little bit complicated, but let me just explain it to you. So this is a chart of gross domestic product. That's the blue line at the very bottom. And again, gross domestic product. This is nominal, not annual rate of change. So it's just in the blue line, that's just the gross domestic product rising. The red line is the actual annual rate of change in gross domestic product. So you can see that even though despite the fact that economic growth is growing, right, the annual rate of change of economic growth is slowing. So it's growing at a slower rate. Now, the kind of the greenish bar going in the background, that is total debt. That's government debt, consumer debt, retail debt, everything, right? So that's the total debt, securities, and loans, liability outstanding. And so again, we just continue to take on more and more debt, which is why as you have taken on more and more debt, and this began back in the early 1980s, but as we began taking on more and more debt, your economic growth rate slows. We used to have expanding economic growth, not slowing economic growth. And that was because we were manufacturing a lot more back in the 60s and 70s. We also didn't have a lot of debt, so there's a lot of money going into productive investment into the economy. That hasn't been the case since the 80s. So as debt continues to grow, we get slower rates of economic growth over time. Now, one of the things, though, that is important to understand is that as debt grows, it is also important to understand the annual rate of change of that debt growth as well, which is also slowed. And since debt provides for economic growth, now this is the key point about this, as debt grows, it provides growth into the economy. Because if I'm borrowing money, I'm spending money. The reason, why am I borrowing money? I don't borrow money to invest it, unless it's on margin debt. But in general, I don't borrow money on credit cards or, take out an auto loan unless I'm going to buy something, right? So if the annual rate of change of debt growth is growing, that supports economic activity. And so when you see big pops in the change in debt, that is supporting economic growth. When it's declining, your annual rate of change of growth is slowing. Okay, but here's the important point. We are only returning back to trend right now. So the trend line is that kind of arced line. That trend line is still lower. So in other words, we still have more to go before you get into recessionary territory. That's why that debt that's supporting economic activity is why we haven't slipped into a recession yet. Even though consumers are running out of savings, yes, wage growth is declining. This is part of next week's article as well. But that liquidity base of debt, credit card debt, auto loan debt, mortgage debt, government debt, all that all winds up in household savings accounts somewhere. Winds up somewhere in the economy. If I take out a mortgage to buy a house, it winds up on the balance sheet of the people that I bought the house from, right? This chart is, this explains this, and this is why this is important. Back to the stock market, that overall liquidity base is still very flush in the economy, which is also helping support the markets because it supports earnings. That monetary base supports earnings growth because of that activity. That is keeping the markets elevated. That's also keeping economic growth heading in the right direction, albeit slower, a slower rate of growth. It is not recessionary as of yet. Households are doing okay here. Again, if you take a look at owners' equity in real estate, it's at some of its highest levels on record. Owners' corporate equity ownership is at its highest level on record. Now, that's a little bit, you got to be a little bit cautious with that second part because that's only the top 10% of the economy that owns that. But household equity ownership is at its highest level on records, but about 87% of that is owned by the top 10% of income earners. The next 40% own everything else. The bottom 50% own basically nothing. They own 2% of the entire equity market. The bottom 50% of the economy owns 2% of the equity market. It's a very small percentage. But again, all that support, and you take a look at consumption, who's driving consumption in the economy as an example, that's also the top 10, 20% of the economy is driving the majority of the consumption. And so as we were talking about earlier, yes, manufacturing is in the doldrums, but there's a very big difference between today and back in the late 70s. Back in late 70s, manufacturing made up about 80% of the economy, about 20% with services. Today, it's 70% services, 30% manufacturing. And services are doing okay. They're not doing fantastic, but they're not recessionary. And because we are so service driven, the actual services sector is keeping the economy or keeping the manufacturing services index in positive territory. So another reason that recession hasn't occurred yet is because the economy's still in kind of expansion mode, but barely, right? It's barely there. Certainly risk of, a contractionary territory, but we haven't been there as of yet. And so this is one of the things that kind of that conundrum that continues to weigh on kind of the markets. And again, if you have a bearish lens to the market, your view is, we're having this recession, I need to be out of the markets and, those type of things. And I get that. That's important. But, this is also why you have to be careful when investing. Because, again, markets are forward-looking, so markets are always looking at economic improvement, those type of things. And right now, this is the big consensus, and this is the third part of the article next week, is the expectation that economic growth might actually start expanding next year. And we'll get into those reasons why next week. But this is important as investors. So it's if you're expecting that shoe to drop and have a big correction in the markets, that it will come eventually, but it may not come soon. It could be a while. I got a couple of emails over the weekend. It's like, I don't understand how you can be invested in this markets right now. It's going to crash. And it's like, well, maybe. But there's no evidence of it at the moment. And what I do know is that in every given year, there are corrections. And we've already had a big one this year. We had a 19% correction this year. And here's a chart of annual versus intra-year returns. This is really important to wrap your brain around. this chart goes back to 1980. You will notice that big drawdowns in markets, annual drawdowns, where the entire year was a negative return, have only happened 9 times since 1980. So think about that for a second. Since 1980, in 45 years, you've had 9 years in total where your entire year was negative. Every other year, yes, you had drawdowns, but you finished the year on the positive side. So if you were just long the index, as an example, in only 9 years since 1980 have you had a down year. Now, just if you were simply, if I said, look, your odds are 9 out of 45 that you're going to have a down year, are you, and you know, how heavily are you going to bet on that? And this is the important part about managing risk and portfolios. And again, there's a lot of things going on right now that are certainly cautionary. As I was explaining at the beginning of the show, you got every asset class, small cap, mid cap, emerging markets, international, gold, Bitcoin, stocks, technology stocks, NASDAQ, all doing exceptionally well. Everything is hitting, pushing record highs. Everything is doing fantastic. There's absolutely really no concern anywhere in any market. Everybody's got a reason for why their particular asset class is going up. Oh yeah, Bitcoin's going up because of this. Gold's going up because of this reason, whatever it is. But at the end of the day, what's driving those asset prices higher are people speculating on price advances. Everybody's speculating that the price is going to continue to go higher. Not every asset class can continue to go higher indefinitely. Eventually, you run out of people's money. And something happens that changes the course or that changes that narrative supporting the drive. And when everything is correlated, the problem with everything being correlated is when you do get that eventual correction, it occurs everywhere all at once. And there's very little place to go for safety. So that's certainly the risk. But in the heart of it, in the heat of it, in the moment of it, we have to pay attention to that. And that's kind of where we are right now. But this brings us to the second part of this conversation, and it brings us to today's article as well, because again, you do have to pay attention to the losses, and I'm not dismissing that whatsoever. Losses are very, very important to understand. And there's always, about once a year, there's always somebody that comes out with an article. And they published this chart that was originally run around. This chart originally came from First Trust. And the First Trust is always bullish. They're always like, hey, just buy the markets and don't worry about anything. Just markets go up over time. It's all good. And so they came out with this chart, and I've recreated this. Now, this is theirs is nominal. This is inflation adjusted. So my numbers are a little bit different than theirs, only because I adjusted it for inflation. Sorry. Forgot to click my pause button. So what this shows you is this is a percentage gains of bull markets and the percentage losses during bear markets going back through history. The general thesis of the conversation that surrounds this chart is that, see, percentage losses, they're nothing. That's just little blips on the road to making a whole lot of money within the markets. So as long as you are fine with the little blips here and there, you're good. Just keep buying the market. This is why you should just buy and hold investments and never really kind of worry about it whatsoever. Because these drawdowns are very, very small in nature. In fact, I'll read to you from one of the recent articles, and again, I said like once a year somebody comes out with this. So here's a quote. Bear markets have asymmetry to them, at least in the short term. In the long term, bull markets versus bear markets are asymmetric. Things are not balanced. Look at the gains versus losses. The bear markets are blips. To be fair, the losses don't feel like blips when you're in them. Bear markets can be brutal. Losing money is not fun, but seeing a large portion of your portfolio can get vaporized because you question your sanity as an investor. And yet, the bull markets completely overwhelm the bear markets. It's not even close. And according to that chart, That's exactly what it looks like. Here's the problem. I want you to ask yourself two questions. First question is, if that's true, if it is true that bear markets are simply blips and you just kind of weed your way through them and everything's fine, why is it that no legendary investor, be it Warren Buffett, Paul Tudor Jones, you name the guy, has a rule that just says buy and hold? Every one of them. Warren Buffett, rule number 1, don't lose money. Rule number 2, referral to rule number 1. Paul Tudor Jones, cut your losses short, let your winners run. Down the line. Not one single historically legendary investor has a rule that says buy and hold. So why is that? Second question is if every legendary investor has a rule that says they're supposed to buy low and sell high in some form, then what's the point of buying and holding? Right? So do these percentage drawdowns really matter? And the answer is yes, they do. Because, again, there's two things that happen during bear market declines. The first is not only the destruction of capital, but there's also one commodity that you don't get more of it. And go back to that chart real quick for me, Brent, that I just showed you. This chart goes back to 1900. Now, raise your hand if you were born in 1900 and are still alive today. There may be somebody out there. I don't know anybody 125 years old, right? But there may be somebody on this planet that's 125. But if you were born and on day one invested in the portfolios and you're still alive today, yeah, none of those blips mattered. You've made money. For most people, time is an important factor, and we're going to get into that a little bit more this morning. But first of all, let's talk about the math of loss. Here's the problem with that chart, is because percentages are an illusion. Let's assume for a second that an index goes from 1,000 to 8,000. Okay? So let's just assume a hypothetical S&P 500 index starts at 1,000 on the index and it grows to 8,000. So from 1,000 to 2,000, that was 100% return. Then it goes to 3,000, so you got a 200% return. You get the idea. So always 7,000. So now I've got a 700% return in the markets. Fantastic. So if an investor bought the index and generated a 700% return on their money, then why worry about a 50% decline, right? See, this is the thesis, is that a 50% decline would only take me from a 700% return to a 650% return. That's not how percentages work. A 50% correction subtracts 50% of the gain. So a 50% correction on an 8,000 index, remember I go from 1,000 to 8,000. I have a 7,000 point gain. But a 50% correction takes me from 8,000 to 4,000, which wipes out a lot of my gain, a tremendous amount of it. In fact, it takes me from a 700% gain to a 300% gain. See, the percentages are deceiving. If I go from $100 investment, you can take this off, Brent. If I go from, say I have a $100 investment in the S&P and I go to 110 and I lose 10% of my money, am I back at 100? No, I'm at 99. The decline, even though they're equal, a 10% gain and a 10% decline are not equal mathematically. And this is why it's very important to understand the math of how this works. Let's take that, and this will clarify if you don't understand that, right? This next chart is going to clarify it for you. All I did was take the original chart in percentages and just convert it back to points. How many points got lost on the index instead of percentages? All of a sudden, this becomes a very different looking chart. All of a sudden, you can see the magnitude of the losses over time. And in fact, historically, the losses wiped out most, not all, but most of the previous gain. And this is a very important concept. Because again, when I'm looking at this in terms of either dollars or points, that's what I'm losing. I'm not losing percentages. I'm losing dollars. And this is why losses are extremely important. This is why we focus so much about risk management, risk controls, those type of things. We want to be invested during those advances in the markets, but we want to try to avoid most of that downturn. We're not going to avoid all of it. Nobody is. But I want to avoid most of it. This is why we talk about the 80-20 rules. We talk about a lot of other things here on the show. But this idea that, oh, don't worry about the percentages, those are blips. Those blips are a lot bigger than you realize they are. And here's the most important fact about this. This is the math of loss. So just assume for a second that we want to have it, and I've showed you this little chart before, but I want to show you again because it's important. This is as an investor, just think about, I want a 10% annualized rate of return. So first year I get 10%, great, I've got a 10% gain. Next year I get 10%, I've got a 10% average return for 2 years. Third year I get 10% more, I've got an average return of 10% for 3 years. Year 4, I just lose 10%. Two things happen here. Again, I just lost 10%. I've got 3 years of 10% gains. I've only lost 1 year at 10%. But it reduces my average return to 5. And then to get back to a 10% return in the next year, I need a 30% gain just to get back to my 10% average annual rate of return. Percentages are deceiving in both directions. Percentage you need to recover and the percentage loss that you actually take in terms of your portfolio. But here's the important thing. Let's just assume I want an average 7% annualized rate of return. I just took the market from where we are currently and I just extrapolated that out at a 7% return with some volatility along the way into the future. But I get an average of 7% rate of return. The purple shaded area in the background is what everybody tells you you're going to get. Oh, the market just compounds at 7% a year. Don't worry about it. That's the blue line, the purple shaded area, right? That's the compounded annual growth at 7% over time. The green is what actually occurred. The orange at the bottom is the differential between where you are in reality versus what everybody tells you you're supposed to get in the markets, because markets just compound at an annual rate. Markets do not compound. Any loss that you take destroys the value of the compounding in the market. The only thing that compounds is something that never loses money, i.e. a treasury bond, all right? Because it just pays you 10% a year, every year, or whatever the bond is paying. Right. So just any interest payment that you get on a bond is just you get that every year, and then the bond matures at face value and you get all your money back. So that's what you get. That compounds. But anything that doesn't grow at a steady rate every single year and has the potential for loss does not compound, because as soon as you have a year of loss, it destroys the compounding effect. And importantly, losses compound downward as well. So this is why it's important. The math of loss is incredibly important. But there's one final aspect to this. It's talking about the function of time. For most people, I know this is true for me, I didn't really get serious about investing until I was probably in my early 30s. Because prior to that, I wasn't making enough to pay rent, those type of things, food, pay for my car, everything else. I was spending all my money just trying to make ends meet for the most part. So I wasn't really in a position financially to really start aggressively saving for retirement and just investing in general until I got into really kind of my mid-30s, kids, all those type of things, right? And that's true for most people. So most people don't get really serious about investing until they're 35. And then you have about 30 years to retirement, and then that's where you are. So most people have about a 35-year window. So what I did is I went back and I pulled life expectancy tables going back to 1900. And we calculated the life expectancy of an investor from kind of their 30s to when they died. And assume they invested all the way through death, right? They never took out any money. They just invested all the way through death. And so what we did, we went back and we looked at that historical time frame in the market versus their actual time to invest in the markets. And what you find out is that through every period, other than now, which we're in the first half of the kind of the bull market right now from 2009 to where we are, we're in the secular bull market. But every previous period during these market cycles, they never achieved their expected compounded rate of return. They always came in short. That's because of the losses. And they simply ran out of time. And the biggest risk for investors is you're close to retirement and you have a big drawdown in the markets, then all of a sudden you can't get to your goals. Think about this. How many investors were on the cusp of retirement in 1998, 1999? They're set. They're golden, right? I got everything I need for retirement. So as long as the markets just keep ginning out, 6, 7, 8% a year, I'm good through retirement. Then the dot-com crisis happens, and as soon as they start to recover back to even, the financial crisis happens, and then 13 years later, say I'm 50 in 1998, I'm now 63 13 years later, and I'm right where I was 13 years later financially. I didn't get my compounded growth rate of 6% a year for retirement for 13 years. So I can't retire. That's the destruction of capital that occurs over time. And that's why that's so important. This is why we spend so much time talking about managing risk and managing returns and trying to avoid these drawdowns, because again, those are the things that truly matter. It's fine to chase markets, right? And again, right now, everything's good. So why not? I mean, NASDAQ's booming, S&P's booming, gold's booming. Every portfolio we're running right now is just doing great. Right? From all weather to crypto to AI to 60-40s, all the portfolios are doing fantastic. It's like, geez, you can't go wrong. You just throw a dart at something and it goes up in price. That's fantastic. Eventually that ends. Now, that doesn't mean tomorrow, doesn't mean next week. Right? I'm not saying that. I'm just saying that eventually you're going to have a reversal in the markets, a reversion. And if you wipe out the majority of your gains because, it's just a pullback, it's just a blip, a 20% drawdown for an entire year matters. And you just saw that in 2022. Most people have forgotten 2022. We had a 20% drawdown in the market. And it set a lot of people back on their heels. Just had a 20% drawdown back in April. That set a lot of people back on their heels. And now we've already forgotten it because markets are doing fantastic. It's like, it's just a blip. Don't worry about it. Buy the dip. That's fine. But at some point, you eventually buy the dip and it doesn't work. And you start compounding losses. And this is the important thing to take away from the conversation this morning, is that I'm not being bearish by any stretch of the imagination, but what I want to stress to you, most importantly, is that it's important to at least deploy some strategies in your portfolio to help minimize the risk of drawdowns if they occur unexpectedly. And I'm not saying they're going to occur anytime soon. Could be next year, could be a year from now, a year later. But this is why we want to employ some strategies. And so I'll list a few in the article for you as well, just to start thinking about it. Again, doing things like limiting your downside risk through, hedging of some sort, carrying some extra cash, rebalancing portfolio risk, those type of things. Those are all just easy things to do. Yes, it caps your gains, right? You may underperform on the upside, but again, this goes back to our 80-20 rule of investing. If I just target 80% of the upside, I'm good if I can just limit my losses to 20% of the downside. I'll far outperform chasing 100% returns over time if I can just manage that downside draw. Again, maintaining a cash buffer, that helps because that also gives you opportunity. So when there's a correction in the markets of some sort, you can bring these up, Brent. If you maintain a cash buffer, it also gives you opportunity. So when there is a drawdown, I've actually got cash to invest. Rather than panic selling on the decline, I've got cash to be buying the decline in assets that I want to own. Rebalance your portfolio with the discipline, right? Every quarter, we just went through a full rebalance in our portfolios into the quarter. We'll do that again in the end of December. But work a rebalance, have a disciplined process to rebalance your portfolio on a regular basis. Yes, that means you're going to sell winners and you're going to rotate that into stuff that's underperforming. Make sure the stuff that's underperforming is still a good investment long-term and that it's actually going to run as a hedge. Don't buy bad stocks. Don't buy bad investments. Those should be cut from your portfolio. But things that are good quality, but just underperforming near term, say for instance, defensive stocks are underperforming technology stocks right now. But when there's a rotation, they'll rotate to defensive stocks. So that's okay to own those in your portfolio. Just make sure they're good companies as you rebalance. Use tactical risk shifts. Again, we talk about taking profits. Sell your laggards. Things that aren't working, bad companies, bad investments, move those out of the portfolio. Be tactical. Protect your retirement. And also, if you're near retirement, remember you don't have that time to recover from a significant loss. So, lower your withdrawal rate during markets if you need to. This is another reason for having a cash buffer, having an emergency fund we talk about. It's important to have those so that during drawdowns in markets, you don't have to accelerate the drawdown and be forced to sell assets to meet withdrawal requirements because you've got that cash buffer. But most importantly, just respect the cycle. Understand that bull markets end. Bear markets end too. They don't last. None of these last forever. Bull markets last longer than bear markets, but bear markets are brutal. And again, it's interesting because the guys that write these articles, like, oh, don't mind the blips. They've actually never been through a bear market. The guy that wrote the article that I was quoting from didn't even start investing until 2010. So, you've never been through a bear market. You've never seen the true devastation caused. Yeah, looking at a piece of paper and just saying, oh, percentages are fine, don't worry about it. They matter a lot when you're in them. But if you've never been in one, you don't know. You're just assuming that these are blips that don't matter and you just don't worry about it. But they're devastating. I've been through the .com. I've been through the bear market. I've seen the devastation caused not just to the people around me, right, that I've seen, but, all the emails and people that we got when we were on the radio show back then from people that have lost, they were heavily indebted on credit card debt to go buy .com stocks, and now they're bankrupt. All right? We've seen the devastation of that real time. It's much worse than you think if you've never been through one. Psychologically, it's devastating. They change people's behaviors for years. We've told you here on the show before that we still have people that come up and say, well, I've been out of the market since 2009. I just could never get back in. Because it just wrecked them psychologically, it just absolutely wrecked them. And that happens. I mean, look, there's people who went through, like my grandmother, she went through the Great Depression and never trusted banks, anybody ever again. Literally, the old story about mattress under a, cash under a mattress, that was her. Never trusted a bank. So these things have major psychological and behavioral impacts, and you cannot ignore them and just go, oh, they're just percentage declines, don't worry about it. But the thing that you have to focus on is we do have to manage our process. We're in a bull market right now. No doubt about that. We need to be investing in the markets right now. We need to be long equities, right? It doesn't matter what you're long. Be long gold, be long equities, be long Bitcoin. It's all working, right? We need to respect that part of the cycle, but also we need to respect the risk that we're taking doing that. You should not be heavily in cash right now. There's no reason to be heavily weighted in cash right now. Should you have some cash? Yes, absolutely. As I said, you should maintain a cash buffer. We've got about 8, 9, 10% cash in our portfolio. Because if I do get a big decline in the next month or two, I want an opportunity to buy some more stuff cheaper. We've had 5 straight months of gains. That's a fairly long stretch. We've gone longer without a down month, but we're getting into the length of advances on a monthly basis that typically you get a drawdown of some sort over a month or so. So I want some cash available for that. But if you're holding 50, 60, 70% cash, you're impairing your returns. And if you're expecting a big drawdown in the markets next week, next month, and I'm talking about, if you're in this market's about to crash camp, there's no evidence of that. And even if it is going to crash, we will begin seeing early evidence of that. And we'll say, and this whole story will change. And we'll say, hey, look, you need to start raising cash, start getting out of markets. This is happening. But you'll start to see rising credit spread risk. You'll start to see markets stuttering, right? You'll start to see asset reversals. We don't have that right now. So again, importantly, we need to manage the risk of what we're doing, right? But we need to be investing. Anyway, hope that helps. Those 2 articles are on the website. The one about the economy and the recession that didn't happen, that was Friday's article. It's on our blog post now. This one today on bear market losses is also on the website right now. So coming up next Friday, we'll have the third part to this article talking about, potential growth in the economy. And then I'm gonna write, because of this one, I'm going to write an article. I've got a long list of rules from some of the world's greatest investors throughout history, from Paul Tudor Jones, Jesse Livermore, et cetera. I'm going to put together kind of an investor guide of trading rules from the legendary greats. And I'll post those on the website in a couple of weeks. But that way you can just print it out, lay it on your desk. And that way, as you're managing your own money, you can just go look back at these great investors and you'll find one thing in common. None of them say buy and hold. But you'll at least have a desk reference of rules, trading rules to follow. So I'll put that together for you and put that on the website. All right. Have a great day. Be sure and like and subscribe to the channel. I appreciate it very much and certainly helps our algorithms, and that helps us keep doing this for you. Because if I stop getting likes, I'm going to stop doing this because there'll be no point. So, just joking. Also, get by the website, realinvestmentadvice.com. Send us your questions and comments if you need it. Always happy to help. And again, I always appreciate good questions. So again, if you send me a question, it may wind up as an article as well. So there you go. All right, have a great day. We'll see y'all back here tomorrow with John Penn, Two Dads on Money. We've got a couple of interesting things to talk about with him tomorrow as well. And also, don't let AI plan your next trip. It apparently gives you destinations that don't actually exist. Who would have thought? All right, see y'all tomorrow.